Welcome back. Well, one of the biggest pieces of news in financial markets over the past couple of years has been the emergence of the inverted bond market, the inverted yield curve. What we're going to talk about today is how to trade the end of that yield curve. Now, a yield curve typically emerges when you have a short-term U.S. Treasury, like the blue line on the left-hand side of the chart. This is in 2007, when that short-term maturity goes above the long-term maturity. That occurs over here in 2007 when the blue line was above the red line. But then when we see a return to normalcy, where the 1 year, the short-term maturity is below the 10-year, that typically coincides with a very fast decline in stock markets. The S&P 500 at this point in gray was at 1550. It's October '07. Well, within about a year's time, we went from 1550 S&P 500 to 1150 S&P 500. Now, it's very important to notice how this happened. It wasn't the fact that the 10-year, the red line went up, the 10-year actually went down, but it's the 1 year, the short-term maturity that really collapsed. Notice how there's very little divergence between the two lines in October of '07. But as we move forward in time, all of a sudden there's an enormous gap. It's the 1 year treasury, the shorter term security that's moving down a lot faster. And that coincides with the stock market going down. Now, the gray area chart in this case is the 10-1 spread. It's the difference between the red line, the 10-year treasury, and the blue line, the 1 year. Now, we did have 2005, we did have the longer term security. The 10-year treasury was higher than the blue line, and that's where we had a normal yield curve. However, we see the spread declining, and then it went negative around April of 2006. That's when the blue line, the 1 year, drifted above the 10-year. But then the inverted yield curve really took place. And at its peak, we had a 50 basis point inversion where the 1 year treasury was 50 basis points, half of 1% above the longer term, the 10-year. Well, notice what happened. October '07, all of a sudden the 1 year collapsed. And that's when this inversion ended. And it's important to note September '07, we were basically flat, meaning the 10 and 1 offered the same yield. But within a very short amount of time, less than 1 year, we went from flat to a 2% spread. The 10-year treasury bond paid 2% more than the 1 year. But it wasn't that the 10 paid 2% more. It was that the 1 year paid 2% less. It was the collapse of the 1 year. That really is the mechanics behind, the ending of an inverted yield curve, at least this past several instances when this actually occurred. Here we see the gray area chart in the background. That's the 10-1 spread. And again, October of '07, notice they were at parity, but then this dropped. And as it dropped, the spread increased. The spread is again the difference between the two. Well, fast forward to present day, where are we? We have about a 60 basis point inversion still. The blue line, the 1 year treasury, is about 60 basis points above the 10-year US Treasury. But at its peak, notice we had a 150 basis point inversion. Remember in 2007, it was only a 50 basis point inversion. We're at 3 times the inversion earlier this year. It has dissipated, but notice what's happening. It's not that the blue line's going down. It's that the 10-year treasury, the red line, is still going up. Now, eventually, perhaps the blue line will follow history and it will crash down. But we have to keep a lookout for that. But it's not happening yet. So far, the 10-year treasury is moving up because at the moment we know the anticipation is we may still have higher interest rates in our future. And the market really hasn't decided if we're going to have a hard or a soft landing. A hard landing is when interest rates go up, the stock market crashes, and the Federal Reserve is forced to cut rates all at once. A softer landing is when maybe the market doesn't go down as much and the Federal Reserve is able to sort of manage a steady decline. Here's the 10-1 spread, again, 2007 versus the S&P 500. And here, notice really how the S&P 500 didn't accelerate lower until the beginning of 2008. And that's when the inverted bond market had ended and we already had a 1% spread. The 10-year bond was already 1% above the 1 year. The 1 year is actually 1% below the 10-year. So the inverted bond market ends. It doesn't necessarily mean the stock market's going to move tomorrow. In fact, in this case, there was a significant delay. Here's the 10-1 spread versus S&P 500 present day. S&P 500 around 4,300. We still have an inverted bond market. And again, this is not a result of the 1 year going down yet. It's really the result of the 10-year that's going up. It's trying to meet the 1 year around 5.5%. Now, here, going back to 2008, this is really, if you're looking for the trade trigger, the 1 year moves faster than the 10 year. Shorter term securities by nature move faster, are more reactive. The most reactive is obviously the federal funds, which are, very short term interest rates. But we see here the 1 month treasury. If the 1 year moves faster than the 10, the 1 month moves faster than both of them. So again, October '07, the inverted bond market ends. The stock market, the S&P 500 starts to go down. The black line is a 1 month treasury note. Notice the correlation. It's not an exact correlation. There are divergences from time to time, but notice a general trend. The S&P 500 from 1500 down to 1200. The 1 year treasury note from around 4.5% down to 0.5%, a 4%, 400 basis point decline. So there really is a strong inversion. And what's happening is that the 1 month moves faster than anything else. So if we were to look at the 1 year and the 10 year, they would be following the 1 month down. But that really is the most reactive of all the treasuries, the short term. Here, present day, the S&P 500 in red, it's still chugging higher. Well, at least up until recently. The 1 year treasury note also moving up. Notice as the S&P 500 has gotten weak over the past, several trading weeks or so, 1 month treasury is kind of flat, just hanging out there on 5.5%. So we want to watch the 1 month treasury notes. We want to see if it makes any significant moves. What's a significant move? We can see we're in a trading range for a while. I would say below 5% or above 6%. In this range between 5 and 6% right now, that seems to be the area it's been in for, several months or so. Now, depending on how this moves next, could be an early signal of what's to come. So the takeaway from this is that we have an inverted bond market. Not every recession is necessarily not every inverted bond market will necessarily lead to a full-blown recession, but every major economic downturn is typically preceded by an inverted bond market. When the inverted bond market ends, at least historically, what has happened is that the short-term securities like the 1 year and really the 1 month treasury, those lead the market lower and stocks typically follow behind. So we're going to be watching these securities and many others along the way, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.